This is the beginning of part 2 of our module on interest rate forwards and swaps. We remind you that this part 2 contains a single chapter, chapter 2, which illustrates the construction of standard and non-standard swaps. This chapter 2 introduces interest rate swaps and their construction and pricing. We begin with a simple 3-year interest rate swap used by a company to hedge its interest rate exposure under floating rate debt, and then proceed to construct more customized swaps used in more complex situations. We begin by assuming that a corporate has borrowed $100 million for 3 years at LIBOR flat and is required to pay quarterly interest based on 3-month LIBOR. The loan has been drawn on January 1, 2009, and therefore matures on January 1, 2012, with interest payments being due on April 1, July 1, and so on. Using the same data as we did above, the spot 3-month LIBOR of 3% means that the company will pay in interest $0.75 million, calculated simply by multiplying the 100 million principal by the interest rate of 3% and then dividing by 4, because the day count for this period is exactly 90 days. What the company will pay in interest for each of the following periods depends, of course, on where LIBOR resets. And this LIBOR could rise or fall from the current level. We would say that the company has exposure to LIBOR in the sense that its interest expense over the next 11 interest periods may rise, thereby reducing the company's financial performance if LIBOR rises. The company has traded FRAs with you before and now asks you to quote them your FRA rate for each of those 11 periods until the loan's maturity. The rates you are showing, which include your profit margin, appear in this table. As you can see, the spot rate for 3-month LIBOR at 3%, then the 3 times 6 FRA rate appears next at 4%, which is a slight upward adjustment over our old 3.9684 to include the profit margin, as explained in the footnote, and so on for all subsequent 3-month periods out to the 12th period that represents the final period under the 3-year loan. Obviously, this forward curve is fictional and has been presented to be artificially smooth and is far smoother than any real forward curve. But its overall shape, namely being steeply upward sloping at first and then becoming a little flatter in later periods, is actually quite typical of a real forward curve. You should readily recognize that the borrower could lock in via individual FRAs the appropriate forward rate for each of the 11 periods for which LIBOR will be resetting. And by doing so, he would have eliminated all future variability in the cost of this debt. This would achieve the company's objective of locking in predetermined payments of interest for the life of the loan, but would leave the borrower with rising interest payments in each quarter. This presents a problem. It will appear in the company's financials that its costs are rising over time, which would be poorly received by analysts who do not understand the reason behind this, namely the shape of the yield curve. What the client really needs is a smoother pattern of cash outflows. And this is where the interest rate swap comes in and will be illustrated in worksheet Simplified IRS Pricing. We can summarize, however, this worksheet by saying that the swap, the interest rate swap's fixed leg, is calculated under that worksheet as the single rate that makes all cash flows which the borrower pays have an aggregate present value equal to the aggregate present value of the unequal cash flows he would have paid under the above listed series of FRA rates. This worksheet, labeled Simplified IRS Pricing 1, which you should now open, lists those rates in column D and shows you the net cash flows the borrower would lock in for each period in column E. One minor technicality to note is that the FRAs in this worksheet are assumed to settle at the end of their related period rather than at the beginning, since this saves us the need to discount the net settlement only to gross it up again for interest in a second step. The worksheet also treats each period as being exactly 1/4 of 1 year, as you can see by opening one of the formulas in column E. You therefore propose to the client to simply smooth out the 12 payments in column E so that the company will always pay the same exact amount of interest in each period. The next worksheet, labeled Simplified IRS Pricing 2, achieves this by deriving first in column E the discount factors appropriate for each cash flow, and then solving for a single constant fixed interest rate in the cell D22, which, if applied to the notional, would generate constant payments in column G whose aggregate PV equals the aggregate PV of the payments in column D. We initially have set this fixed rate at a flat 5%, expecting that it will not be absolutely right. And then we will use goal seek in Excel to derive the correct rate exactly. From this worksheet, we can see that the 5% rate was too low, since the aggregate PV of the new cash flows shown in cell H18 is lower than the original aggregate PV of the original cash flows appearing in cell F18. The difference of $621,000 plus change appearing in cell G20 would in effect represent the upfront loss the bank would be incurring if it allowed the borrower to pay only 5% as the fixed rate. Now we resort to goal-seek to find the exact solution, i.e. the one that leaves the PV difference in cell G20 equal to 0. Thus, Tools, Goal-Seek, set cell G20 equal to value 0 by changing cell D22, hit OK, and this reveals in cell D22 a fixed rate of approximately 5.22%. You have just priced your first interest rate swap. It is customary to show the loan once it is swapped under the IRS contract via a diagram which looks like this. In effect, the cash flows of LIBOR under the loan offset the cash flows of LIBOR under the swap on each and every settlement date, leaving the company paying the fixed rate of 5.22% on a quarterly basis. The swap has enabled the company to synthetically create fixed rate debt in lieu of the floating rate debt it started with. We should emphasize that while this diagram resembles closely the one we used for the FRA, it is different in two important respects. First, all settlements under the IRS are made at the end of the period to which they relate. Remember that for a FRA, the usual settlement custom is to settle at the beginning of the period in question. Second difference, there will be 12 separate settlements under the swap versus, of course, only one settlement under a FRA contract. Nonetheless, the diagram for the swap, shown here, uses only one arrow in each direction to show all 12 settlements under the swap. We described our earlier approach to pricing the swap as an approximation, since it ignored the exact day count in each period and treated them all as a quarter of 1 year to keep matters simple. Let us see how much inaccuracy this simplification introduced. This worksheet labeled IRS correct pricing now takes the exact time periods into account, but is otherwise identical to the previous worksheet in all other respects. Columns C, D, and E, which we have hidden to preserve space, take care of the day count. And the formulas in columns G and J, as well as in column H for the discount factors, have been modified to reflect the corrected day counts. Something you should please confirm to your satisfaction by opening the formulas behind these cells. You will see that the changes to the individual cash flows versus the previous worksheet are quite significant, but that in aggregate they tend to cancel out to a large degree. GoalSeek once again enables us to calculate the swap rate correctly on this worksheet, which for now has been incorrectly set at the 5% rate as we did in the previous worksheet. Thus, as before, Tools, GoalSeek, set cell J20 equal to value 0 by changing cell G22 and hit OK, revealing a solution this time of 5.2263%, very close to the previous one. Returning now to our slide on the approximate swap formula, we have found through worksheet IRS correct pricing that our approximation of 5.22% versus the correct swap rate, which turns out to be rounded to 2 decimals, 5.23%, was only 1 basis point away from each other. Since our approximation of 5.22% has turned out to be reasonably accurate, we summarize its logic using some algebra, which enables us to derive a nice closed-end formula for calculating a swap rate merely from discount factors and FRAs. Under the simplified approach, we effectively wrote the following equation. Sum of the fixed rate cash flows, each time dividing those cash flows by 4 based on the fixed rate F multiplied by the notional, and in each case multiplying that amount by its appropriate discount factor, DFI, and then summing all of those amounts gives us the left-hand part of the formula, and we set that equal to the sum of the notional multiplied by the LIBOR corresponding to that period, again divided by 4 and again multiplied by its discount factor. This formula simplifies to what you see in front of you here, where you will notice the N for notional dropping out completely from the formula, and illustrates really well why people often say that the swap rate is the time-weighted average of the relevant LIBORs. We are done with our discussion of standardized or basic interest rate swaps, and will now proceed to examining how we can customize more difficult or tailored swaps. We will customize swaps that modify each of the following features in turn, and then ask you to price one which combines a number of these modifications: a profit margin for the dealer, a notional amount that changes over time, a forward starting date, different settlement frequencies between the floating leg and the fixed leg, and or also different day counts, and finally a feature that fixes the LIBOR reset under the swap at the end rather than the beginning of the period in question. This kind of swap is known as a LIBOR in arrears swap. Each of these, except the first, is examined via its own worksheet. Staying for now with worksheet IRS correct pricing, if the dealer wants a profit margin whose NPV on a $100 million notional is, let us say, $375,000, you would simply replace the zero we used previously in the goal-seek operator with this desired amount, making sure to write it in with the correct sign and in the correct units. For the dealer to make a profit when the client is paying fixed, the dealer would need to lift the fixed rate a little bit. Since the formula in cell J20 subtracts the fixed PV from the floating PV, as you can see here, you would want this number to become negative in order for the dealer to make a profit. Thus, Tools, Goal-Seek, set cell J20 to value minus 375,000 by changing cell G22, hit OK, yields a solution of approximately 5.36%. There is really nothing more to say about this example. Now assume the loan we have been discussing amortizes in the last year in 4 equal installments of principal. The borrower would obviously need the swap notional to amortize in parallel with the loan, otherwise it will find itself overhedged in year 3. It is easy to mess up the adjustments you need to reflect amortizations. Although we say that the loan amortizes in year 3, please note that the first reduction in the principal from 100 million to 75 million would not take place until the end of the first quarter in that year, i.e. at the end of period 9. Any earlier or later date for the first amortization would contradict the 3-year stated final maturity of the loan. By the same token, the notional at the beginning of period 12 is therefore 25 million and not 0. Please make sure you are comfortable with this statement before proceeding further. Now you simply need to adjust the notional of the swap for each period, which therefore requires, in our worksheet, a new column for this notional. Worksheet Amortizing Swap demonstrates how this is done. But before turning to it, we ask you to predict the outcome intuitively, i.e., whether the rate will become higher or lower than before by thinking about the shape of the forward curve. Click pause while you do this, and then click play when you are ready. Worksheet Amortizing Swap, which you see here, modifies the previous worksheet to include a new column, column H, with the declining notional amount. Due to space restrictions, we have now hidden the columns showing each period's number and the discount factors. Working as before, we set Tools, Goal Seek, set, in this case, cell L20 to value 0 by changing our old Mr. 5% guess. Hit OK, and this reveals a swap rate for the amortizing swap of 5.05%. In fact, the LIBOR spot and forward curve could have allowed you to predict the outcome via the simple observation that the declining notional in the last year means that the highest LIBOR forward values that have just been highlighted will now be receiving in the calculation a lower weight than they would under the bullet swap, bringing the all-in swap rate down from what was previously, you should recall, 5.22 or 5.23%, ignoring any profit margin. We can summarize the most recent part of our conversation by saying that the reducing notionals in year 3 puts lower weights on the higher LIBORs, which occur towards the end of the life of the swap when the curve is upward sloping, and therefore cause the swap rate to decrease. And by the same kind of logic, we would find that the swap rate would increase if the curve is inverted. A swap whose notional increases over time, called usually an accreting swap, and often used to hedge a construction loan or a project financing, in which the loan itself is typically drawn in several parts over time as the construction or project progresses, behaves in exactly the opposite way to an amortizing swap. Specifically, an accreting swap would have a higher rate than a bullet swap in an upward sloping curve environment and a lower rate in an inverted curve environment. These 4 results can be summarized in the following table, showing a lower swap rate for an amortizing swap in an upward curve environment, vice versa in a downward curve environment, a higher swap rate for an accreting swap in an upward curve environment and a lower rate in a downward curve environment. Next, we assume that the borrower has obtained a commitment for a 2-year bullet loan instead of 3 years, but will not draw on the loan until exactly 1 year from today. The swap that would enable the borrower to lock in a fixed rate from the moment the loan is drawn has the self-explanatory name of forward starting swap, the title of this slide. You should once again try for a moment to predict whether the rate will be higher or lower than for the bullet swap by thinking about the forward curve shape. The only real difference when pricing a forward starting swap is that the notional in the spreadsheet would be set to 0 until the start date. Therefore, in an upward sloping curve environment, a forward start swap rate will exceed a spot start swap rate, since the LIBORs with the lowest values in the LIBOR curve will be given weights of 0, causing the average to rise. And once again, the opposite of this statement will be true in an inverted curve environment. We illustrate this via the worksheet Forward Starting Swap, where you will note that the only changes we have made are to set these 4 cells with the notional amounts for the first 4 quarters to 0. In effect, this eliminates from the calculation the 4 lowest values in column G from the averaging process, and therefore lifts the swap rate appearing in cell I-22 to 586 as predicted. One interesting thing to note in this worksheet is that with these 4 LIBOR values gone, the ones that remain for purposes of the calculation all lie in a perfectly straight line. Note at the bottom of the slide Excel informing you just underneath the tab named frequency that the arithmetical average of these 8 numbers is 588%. Very close indeed to the correct swap rate of 586%. This shortcut approximation for determining a swap rate works pretty well in the unrealistic example of a curve that has the shape of a straight line. But it works far less well when the curve is not so well behaved, which is unfortunately the usual case in real life, of course. The next alteration we might consider for a swap would involve a change in the frequency or the day count convention of one of the 2 legs. Dealing with different frequencies and day counts on the 2 swap legs is painful but necessary, since this is very often how a real swap works. The borrower, for example, may have a fixed rate 3-year bond outstanding, paying semi-annual coupons under a 30-360 convention, and would like to compare his fixed rate under the swap bank facility to that under this bond. Unless the fixed leg under the swap also has a semi-annual frequency and a 3360 convention, the comparison would be inaccurate. The floating leg of the swap, of course, would not be amended in the same way, since that leg needs to match perfectly the frequency and day count of the bank loan. Worksheet frequency contains all the necessary amendments, which you should scrutinize carefully until you are satisfied. The new 3-year bullet swap rate appearing in cell I-21 comes to 5.33% versus our original 5.23%. Note in particular the 3360 convention in column L as contrasted with the actual 360 convention for the LIBOR payments in column I. And of course, you will also note the very obvious difference in the frequencies between column I, which is quarterly, and column L, which is semi-annual. The rate we just calculated of 5.33% could in fact have been approximated from the original 5.23% quarterly rate by first converting it into a semi-annual rate and then adjusting for the day count by multiplying each result by 365 over 360. This is shown at the bottom of this worksheet in the cells we have just highlighted, specifically H, I, and K from 24 to 27. We will examine now the formulas behind these adjustments, but please note that most of the Excel functions we use here were explained in our earlier modules on financial math, so we will not go through them in any great detail. As a first step, you need to convert the 5.23% quarterly rate into an effective rate. This is achieved in cell H25 via the Excel operator effect, which requires you simply to specify the nominal rate as the 5.23% and to insert 4 on account of the quarterly frequency. Next, you kind of need to reverse direction and figure out the nominal semi-annual rate that is equivalent to this effective annual rate of 5.33. And this is done in cell H26 via the Excel operator nominal, which requires you to specify the effective rate calculated in the cell above, and then insert 2, specifying the semi-annual frequency. Lastly, in the cell underneath, H27, you simply multiply the previous number by 365 over 360 on account of the day count difference and obtain 5.34. Almost exactly the same result, ignoring some rounding issues as we had discovered here for 5.33. Our next amendment to the standard swap, the LIBOR in arrears swap, needs a little explanation, particularly with regard to the logic for its invention. Assume the same LIBOR curve shape as before, but that the borrower wants to swap this time from fixed into floating to benefit from an anticipated decline in interest rates. Assume also that the borrower is swapping out of a 3-year quarterly pay bond whose fixed coupon is 5.53%, as indicated here. And remember that this is roughly 30 basis points higher than the 3-year swap rate we calculated before. By entering into the swap, shown in this diagram, the borrower creates a synthetic floating rate debt at an all-in cost of LIBOR plus 30 basis points, represented by the difference between the 5.53 he's paying on the bond and the 5.23 he's receiving under the swap. Note that this diagram essentially reverses the usual direction of the arrows as compared to any previous diagrams we have drawn for interest rate swaps. The borrower, having calculated his all-in cost as LIBOR plus 30 basis points, naturally now asks you whether you can do something to reduce or eliminate the spread over LIBOR under the synthetic facility you have structured. In more advanced modules, we will be illustrating techniques for improving a customer's rate under a swap by, for example, asking the client to tolerate some level of optionality in favor of the bank, such as an option to extend the swap at its maturity, or to convert the currency of some of the cash flows under the swap, or to reduce the notional of the swap on certain specified dates, and so on. The LIBOR in arrears, or LIA for short, alternative we are discussing here avoids any sale of optionality and is therefore more suitable for those borrowers unable or unwilling to consider the sale of options. The mechanics of this instrument remain exactly the same as those of our original swap in all respects, including with regard to maturity, settlement dates, frequency, and so on, with the only exception being that the calculation, or commonly known as the fixing, of LIBOR for each period is based on the LIBOR that resets 2 days before the end of that period, as opposed to 2 days before the beginning of that period under a normal swap. With an upward sloping curve, the use of the later LIBOR for each period will drive upward the calculation of the swap rate, thereby bringing it closer to the borrower's cost of 5.53% under his outstanding bond. Note that one peculiarity of the LIA fixing method is that the borrower would not know what he pays under the swap, and therefore would not know his interest cost all in for any one period until 2 days before the end of that period. A very unusual feature in normal debt instruments. Worksheet LIA amends the original worksheet in two ways. First, it now provides, in cell G17 here, one more forward rate, which has become necessary to replace the one that drops out, i.e., the one in cell G5, which will no longer have any impact on the cash flows and therefore the pricing of the LIA swap. In addition, this worksheet amends the formula for the payments under the floating leg and only under the floating leg by tying them to the LIBOR on the next row rather than the one on the same row, as has appeared here. The LIBOR in arrears swap rate, which we have priced already here, turns out to be, as you can see in cell I22, 5.56%, which would mean that under the LIA swap in our previous diagram, the borrower's all-in cost moves down to LIBOR minus 3 basis points. Remember, the borrower was only paying 5.53 on the bond, and here would be receiving 5.56 and paying LIBOR under the swap. But of course, the LIBOR mentioned in this all-in rate is no longer the same LIBOR as before, and in fact is one that is expected on average, according to the shape of the curve, to be higher over time than under our original normal definition of LIBOR. Returning then to our last slide on LIBOR in arrears, it should become obvious that a borrower who feels that LIBOR forward rates generally overstate the eventual outcome in LIBOR would find the LIA alternative especially attractive. More advanced modules will discuss the accuracy of LIBOR forwards as predictors of future rates and show that historically there is indeed significant evidence in support of the belief that LIBOR forwards, on average, overstate any eventual increases in LIBOR, again on average. We can complete this discussion of LIA instruments by making one last but very important point, namely that the pricing of the LIA swap shown in our worksheet is in fact not completely accurate. For highly technical reasons, which we cannot explain in this module, something known as a convexity adjustment is needed to correctly price the LIA swap. This adjustment is quite small usually, of the order perhaps of less than 1 basis point, but does become more significant for longer tenor swaps and especially during periods of high interest rate volatility. We conclude this chapter 2 by describing one other way it is possible to structure and price swaps, especially common in markets that have little or no FRA liquidity, but some decent liquidity in the bond market. Assume you have been asked to quote on a 5-year swap in which you will pay 6-month LIBOR and receive fixed semi-annually. You go ahead and issue a 5-year bond and invest the proceeds in a 5-year floating rate note that pays 6-month LIBOR flat. Note that your net initial proceeds are zero, and also that the repayment of your investment's principal in 5 years would repay the bond you have issued. So again, there will be no net cash flow of principal. The diagram you see here shows the semi-annual payments under the two bonds and under the swap, and should make clear that to break even under the swap, you would price the swap's fixed leg, appearing at the bottom right of the diagram, at the exact same rate as the coupon you are paying on your bond liability, as appears on the bottom left of the diagram. In practice, pricing would not be quite so straightforward, as you would need also to account for the use of your balance sheet, the need to allocate some regulatory capital against your investment in the FRN, and the credit risk of your investment, which applies now to the entire principal of the investment in the FRN. This insight, however, is a very useful one. Any IRS can really be viewed as two bond positions, one long and one short. If you are receiving fixed under the swap and paying floating, it is as if you have issued a LIBOR-based liability and invested the proceeds in a fixed-rate bond, and vice versa. Please retain this insight, as it will help you understand much better the concepts of swap duration and swap convexity when we reach them in Chapter 4 of Part 2 of this module. The decomposition of an interest rate swap into two bond positions, as we just explained, can be applied more extensively. For example, to price what is known as a LIBOR basis swap between two currencies. Assume your bank wants to borrow 100 million pounds sterling for 5 years, but has no access to the sterling funding market. The sterling dollar spot rate is 1.5. Your bank issues a $150 million 5-year floating rate note, which pays 6-month dollar LIBOR, and converts the proceeds into 100 million sterling in the spot FX market. Assume now another bank in the UK wants to borrow $150 million for 5 years, but has no access to the US dollar funding market. This bank issues a 100 million sterling 5-year FRN domestically, which pays 6-month sterling LIBOR, and converts the proceeds into $150 million in the FX spot market again. Now, assume the two banks enter into the swap described in this diagram. The US dollar payments you receive under the swap, shown by arrows going from the right to the left, are exactly what you need to pay off your lenders for both interest and principal. while the sterling payments your counterparty receives, appearing as the arrows going from left to right, are exactly what she needs to pay off her lenders. Each of you is left, in effect, with synthetic floating rate funding in the amount and in the currency you desired. This kind of swap is called a LIBOR basis swap and plays a very important role in both the funding operations of large banks as well as in the pricing for cross-currency swaps for customers, as we will see in Chapter 3. Note very carefully that unlike an IRS, a LIBOR basis swap includes an exchange of principal at maturity, appearing as the two dotted arrows in this diagram, without which neither party would have been properly hedged as to the principal of its bond in our example. The screen for a sterling dollar LIBOR basis swap might typically look as follows. The points appearing in the table in the columns bid and offer refer to a necessary adjustment to the non-dollar leg, in this case the sterling leg, and are expressed in basis points over LIBOR. And these stem essentially from an imbalance in the market with a preference for being on one side of the market rather than the other side. Thus, if a client calls you asking for a 3-year basis swap in which he wishes to make the sterling payments, you can read the screen as implying that your client would receive dollar LIBOR flat, always flat for the dollar LIBOR leg, whereas the client would have to pay an annualized 3 basis points, being the offer side in this table, to each sterling LIBOR payment he makes. If conversely he wishes to receive the sterling LIBOR payments, he would receive LIBOR in sterling plus 1 basis point only against paying dollar LIBOR flat. And please remember that in both cases there would still be an exchange of principal, $150 million for 100 million sterling on the maturity date of the basis